An option is a type of financial contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and date in the future. Options are commonly used by traders and investors to manage risk and speculate on future price movements in a wide range of financial and commodity markets. In this video, we'll explore the basics of options, how they work, and the key features that make them unique. What are options? An option is a contract between two parties, the buyer and the seller, which gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and date in the future. The underlying asset can be anything from stocks, bonds, and currencies to commodities such as oil, gold, or wheat. Options come in two varieties: call options and put options. A call option gives the buyer the right to buy the underlying asset at a predetermined price, while a put option gives the buyer the right to sell the underlying asset at a predetermined price. How do options work? Options are typically used by traders and investors to manage risk and speculate on future price movements. For example, a stock investor may buy a put option to protect against a potential decline in the stock price. If the stock price falls, the investor can exercise the put option and sell the stock at the predetermined price, limiting their losses. On the other side of the trade, a speculator may buy a call option to profit from an expected rise in the stock price. If the stock price increases, the speculator can exercise the call option and buy the stock at the predetermined price, then sell it at a higher price in the market to make a profit. Options have several key features that make them unique compared to other financial instruments. Flexibility. Options give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and date in the future. This flexibility allows investors to tailor their trades to their specific objectives. Leverage. Options require a small amount of capital to control a large amount of underlying assets. This leverage can magnify both gains and losses. Premium. Options have a premium, which is the price paid by the buyer to the seller for the right to buy or sell the underlying asset. The premium is determined by a number of factors, including the current market price of the underlying asset, the time until expiration, and the volatility of the underlying asset. Expiration. Options have an expiration date, which is the date by which the buyer must exercise the option or it becomes worthless. Most options expire on the third Friday of the month. Options are a powerful financial tool used by traders and investors to manage risk and speculate on future price movements. They give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and date in the future. Options are flexible, leveraged, and have a premium and expiration date. Options can be complex, and it's important to understand the risks and benefits before trading them. With careful consideration and proper research, options can be an effective way to achieve your investment objectives.